Let's face it, the economy is a bit like a roller coaster. It has its ups and downs, twists and turns. But, just like a roller coaster, these movements aren't random. They follow patterns we call economic cycles. Understanding these cycles is essential for your financial well-being. It doesn't matter if you're a seasoned investor or just starting. Knowing where we are in the economic cycle can help you make smarter decisions. It's about knowing when to invest boldly and when to be more cautious. It's about riding the waves of economic change, not being wiped out by them. Are you ready to become an economic cycle expert? Let's dive in. Imagine the economy as a giant wheel, constantly turning through four distinct phases: expansion, peak, recession, and recovery. These phases are like the seasons of the year, each bringing its own unique set of circumstances and influencing the way businesses and individuals operate. Each phase has its own characteristics, its own set of opportunities and challenges. Understanding these phases can help businesses and individuals make better decisions, whether it's about investing, hiring, or saving. Expansion is the boom time. The economy grows, businesses flourish, and unemployment is low. During this phase, consumer confidence is high, and people are more willing to spend money on goods and services. People feel confident, spending money and investing freely. This increased spending leads to higher demand for products and services, which in turn encourages businesses to expand and hire more employees. It's a time of prosperity, but it doesn't last forever. As the economy continues to grow, it eventually reaches a point where it can no longer sustain such rapid expansion. Eventually, the expansion reaches its peak. This is the highest point of economic activity. At this stage, the economy is operating at full capacity, and any further growth becomes increasingly difficult. But beware, what goes up must come down. The peak is often followed by a period of decline, as the economy begins to slow down and enter a recession. After the peak comes the downturn, also known as a recession. This phase is characterized by a decrease in economic activity as businesses cut back on production and lay off workers. This is a period of economic contraction. Businesses struggle, unemployment rises, and people tighten their belts. Consumer confidence drops, leading to reduced spending and further economic decline. It can be a challenging time, but it's important to remember that recessions are a natural part of the economic cycle. They serve to correct imbalances in the economy and pave the way for future growth. Finally, after the recession comes the recovery. This phase marks the beginning of a new cycle of growth as the economy starts to heal and rebuild. This is when the economy starts to heal. Businesses slowly begin to hire again, and consumer confidence starts to return. People become more willing to spend money, which helps to stimulate economic activity. It's a time of cautious optimism as the economy slowly but surely begins to climb back up. The recovery phase can be slow and gradual, but it sets the stage for the next period of expansion and growth. Understanding the four phases of economic cycles can help us navigate the ups and downs of the economy. By recognizing the signs of each phase, we can make more informed decisions and better prepare for the future. Just like the seasons, the economic cycle is a natural and ongoing process. By staying informed and adaptable, we can thrive in any economic environment. Whether you're a business owner, an investor, or simply someone trying to manage your personal finances, understanding the economic cycle can provide valuable insights and help you make better choices. So the next time you hear about the economy being in a particular phase, remember that it's all part of a larger cycle. And with each turn of the wheel, new opportunities and challenges will arise, shaping the future of our economy. History is a powerful teacher, especially when it comes to economic cycles. By examining the past, we can gain valuable insights into the patterns and behaviors that shape our financial world. The Great Depression of the 1930s stands as a stark reminder of how severe economic downturns can be. It was a time when the global economy came to a grinding halt, and the effects were felt by millions. It was a period of widespread hardship, with unemployment soaring to unprecedented levels. Families were torn apart, and communities struggled to survive. The images of long unemployment lines and desperate faces are etched into our collective memory. The 2008 financial crisis, while not as severe as the Great Depression, also left a lasting impact. It was a stark reminder that even in modern times, our financial systems are vulnerable to collapse. Triggered by a collapse in the housing market, it led to a global recession and highlighted the interconnectedness of the global economy. The ripple effects were felt worldwide. from foreclosed homes to empty office buildings, and the economic pain was widespread. These historical examples teach us the importance of understanding the causes and consequences of economic cycles. By delving into the details of these crises, we can uncover the underlying factors that led to such widespread economic turmoil. By studying the past, we can better prepare for the future. We can identify the warning signs that precede economic downturns and take proactive measures to mitigate their impact. This knowledge empowers us to make more informed decisions and build more resilient financial systems. We can learn to recognize warning signs and make more informed decisions. For instance, understanding the role of speculative bubbles, excessive leverage, and regulatory failures can help us avoid repeating the same mistakes. Remember, history doesn't repeat itself, but it often rhymes. By drawing parallels between past and present, we can gain a deeper understanding of the economic forces at play and navigate the complexities of our financial world with greater confidence. While every economic cycle is unique, they often share common threads. These threads can be seen in the way economies expand and contract over time, influenced by a variety of factors including consumer behavior, government policies, and global events. Understanding these patterns can provide valuable insights into the future. By studying past cycles, we can start to recognize patterns in how the economy behaves. Historical data offers a treasure trove of information, revealing how different sectors respond to various stimuli. For instance, the stock market often reacts to changes in interest rates, while consumer spending might be influenced by employment rates. For example, periods of rapid economic expansion are often followed by periods of correction. During these times, businesses may overextend themselves, leading to a surge in production and investment. However, this rapid growth can create imbalances that need to be corrected, resulting in a slowdown or even a recession. This is because unsustainable growth can lead to imbalances, such as asset bubbles or excessive debt. When these bubbles burst, the economy can experience significant downturns. The housing market crash of 2008 is a prime example, where excessive lending and speculative investments led to a severe financial crisis. Similarly, recessions are often preceded by periods of rising inflation or excessive speculation. When prices rise too quickly, it can erode purchasing power and lead to reduced consumer spending. Speculative bubbles, on the other hand, can create a false sense of security, encouraging risky investments that may not be sustainable in the long run. By recognizing these patterns, we can better anticipate potential turning points in the economy. This knowledge allows investors to adjust their portfolios, businesses to plan for future growth, and policymakers to implement measures that can mitigate the impact of economic downturns. This doesn't mean we can predict the future with certainty. The economy is influenced by countless variables, many of which are unpredictable. However, understanding the cyclical nature of economic activity can provide a framework for making more informed decisions. However, by understanding the cyclical nature of the economy, we can make more informed decisions about our investments, our careers, and our overall financial well-being. For instance, during periods of economic expansion, it might be wise to invest in growth-oriented assets, while during downturns, more conservative investments might be preferable. Remember, knowledge is power, especially when it comes to navigating the ups and downs of the economic roller coaster. By staying informed and understanding the underlying patterns, we can better prepare for the future, making strategic decisions that enhance our financial stability and growth. Whether you're an investor, a business owner, or simply someone looking to secure your financial future, recognizing these economic patterns is a crucial step towards achieving your goals.